Hi everyone, welcome to another session of Valuing Analyzing Companies. Today's session I will be covering La-Z-Boy. La-Z-Boy is a retail store where they sell furnitures and they were founded in 1927. Their headquarters in Michigan and their stock is down about 45% over the course of the year. And I was curious if the current valuation looks attractive, so I decided to do a deep dive, and I will be walking you through my analysis. The company is about 2.7 billion in revenue based on trailing 12 months number, and having a 1.1 billion in market cap. It's very small. The following is the mix of the ownerships. BlackRock owns about 16%, Vanguard close to 11%, Wellington Management is a private equity company out of Boston, owns about 6%, and DFA, Dimensional Fund Advisor, owns about 5.5%, which is pretty interesting. DFA is known for its philosophy of low price to book. Ken French and the Nobel laureate Eugene Fama are the key individual involved in the firm, working with David Booth since its birth. Eugene Fama is known for his contribution to finance. He's a Nobel laureate due to his contribution for a multi-factor model. That they have a little bit of systematic way as opposed to going, performing individual DCF as far as I am aware. But this is an indication that DFA has done some due diligence. They're focused on the fundamentals as well as these ratios, and try to craft a diversified portfolio based on a small cap values across different funds that they have. I haven't gone and looked at which ETFs or which funds contains this La-Z-Boy specifically, like what percentage of the holding this would make up. But the fact that they have 5.5% of this company, it's not negligible. And it gives me a sense that they are most likely bullish on this company finding as value investment. That this is just something that I noticed on the surface. The other thing to mention, Miss Melinda, current CEO, used to be the CFO of La-Z-Boy, and she worked at KPMG. I believe she was in audit, and then she was at P&G for over 20 years. Based on my calculation, her holding translates to about 2.9 million based on current price, and all the director holdings translate to about 18.3 million, which translates to about 1.83% of the total company collectively, including Melinda's holding. The other thing to mention is the CEO compensation. Only 20% of it is made up by the base, the salary that she would get. The rest of it is based on options and stocks. I'm not a fan of stock options. I'm a fan of restricted stock unit that gets vested over a long period of time. But overall, it's a good compensation framework in my view that keeps the CEO having a skin in the game. With that said, let's get to some fundamental analysis. The unlevered beta of retails and furniture businesses has been fluctuating between 1.3 to 0.7. I'll take a average about 1, if you would say. As far as solvency of La-Z-Boy, the quick ratio is about 1.5. The long-term ratio, if you would say, total asset divided by total liability, and I exclude goodwill because goodwill is just a plug variable that accountant plug into the balance sheet. When the balance sheet doesn't balance, it's usually make up its way to the balance sheet when they do an acquisition and they overpay. And in this case, we can see that they perform some acquisition and they overpay relative to the book value of that target company that they acquired. So I take account for that. The company is pretty much solvent. The next thing to take a look at is their debt to equity ratio. That is about 38%. They don't have like outstanding loan or debt, if you would say, in terms of money that they've borrowed. It's the value of the leases. So I believe since 2019 or 2020, IFRS and GAAP required companies to capitalize the leases. Before then, they used to deduct the rent that paid for these stores that they leased from the operating income. So that wasn't reflective of their operating margin. So there have been some changes in the accounting. But overall, this debt to equity ratio that you would look, it's based on the lease value over the market value of their equity. If you would think of how much they own to the banks or to the lenders, they don't owe any money to lenders or banks, but they do owe money to the owners of the store that they leased, and that adds up to about 430 million, roughly speaking. That's the value of the debt of the leases. And 204 is how much they have cash on hand. The Buffett SG&A ratio is essentially the SG&A divided by gross profit. That number is usually high for retail businesses. Warren Buffett likes this number to be below 30%, but that doesn't hold water for every company across every industry. It varies. Revenue, as you would see, pre-pandemic was about 1.7 billion. Then we see the pandemic effect, and then it shoots up, and it's about 1.4 billion, roughly speaking now. The operating margin pre-pandemic, you would say, since 2014, this number has been around 6%, expanding higher, and then heading lower a little bit. Then we see the pandemic effect, and then trailing 12 months, this number is about 9.4%. Most recent quarter, about 10%. The highest they've reached was 2 quarters ago, which was about 11.5%. Their operating income ratio relative to the peers like Ethan Allen, BC, etc., seems to be outstanding. I mean, Ethan Allen has been making record for the past 2 years. I don't think those numbers would be sustainable, and they're really outliers. I have to dive deeper on what was happening with Ethan Allen. But for Lazy Boy, this number has been consistent, and this is what I would like to see. And it's been, pretty much competitive with the peers that I have in my sample. Their sales to capital ratio has been heading lower as they've been acquiring more assets. They're being less efficient, but it's not too concerning in my view, and it's at its current rate, put them in parity with other peers that they have in my sample, so I'm fine with that. The return on invested capital, I can see this number on yearly basis consistently being around 10-11%, which is, that consistently beats its peers that I have in the sample again, which is pretty solid. This is really the two key fundamental metrics that I would be focused on: operating margin and return on invested capital. Here you can see that as the revenue has been growing, what has been the mix in the cost of revenue ratio, and what has been the mix of the SG&A, which has been, as revenue grows, the mix has been remaining the same, which is good. The SG&A shrinked a little bit, which is good, means they're getting more efficiency with less headcounts. This is the return on invested capital chart on quarterly frequency based on trailing 12 months number. So if we look at the return on invested capital, the blue line or the green line would be, the representative of the return on invested capital, and that number is somewhere between 10 to 16. I'll usually take the midpoint estimate between 13%. And the return on equity is about 20%, but I think this number will, regress to its long-term average, which would be about 10 to 12%, and return on asset is very close again, around 9%. Again, these numbers are close because they don't have much of debt going on. The sales to capital ratio has been, for 10, 12 months, has been around somewhere between 1.5 to 2.40. I would take the midpoint as a 1.8, 1.9 as my estimate. This chart represents the dividend that has been paid out to the investors. It's clearly illustrative that the operating cash flows are able to sustain the dividend they've been paying. So they have currently about the dividend yield of about 2.9, 2.8%, which is pretty sustainable with the operation that they've been having. So what is the story that I have to say about Lazy Boy? I tend to think that Lazy Boy will experience a decline in revenue, which will perhaps last for about 3-4 years due to macro factors, going to a recession, etc. There will be a recovery in growth again. Just like every other economic cycle, we're going to get through it, and no, not much tightening. It's going to be again growth, booming, etc. Blah blah blah, and they're going to experience growth as well as people will be buying more homes and spending more money in buying furnitures. And then after that, I can value the company as a going concern. So that's pretty much the big picture I'm focused on. That's what I think will manifest. Think of this table as an Excel file. The revenue for the trailing 12 months about 2.4. I am reducing by 7% and then 6% and then 4% and 3% for the next 4 years. And then from there, I'm going to grow the revenue by 7.5% and then 5% for the year after and 1% the year after, then by negative 2%. And then I will give another cycle that will last for um, from 4 to 3%, and then I will value the company as a going concern. I'm also reducing the operating margin. As you saw, the operating margin is at its all-time high. It's a combination of capitalizing leases and also high demand in furnitures post pandemics. I tend to think that number will regress to its long-term average, call it regression to the mean. And I am reducing the operating margin from 9.4 to 8%. The reason I chose 1.3 is because this number is from next year, not current year. So with that said, here's my EBIT, earning before interest and taxes. This is the sales to capital ratio. Essentially, the difference in revenue divided by sales to capital ratio is how much they have to reinvest to grow the business. Since I have a negative growth, they're not reinvesting anything that year, so their investment is zero. This is the present value to the cash, the present value of free cash flow to the firm. Uh, so in the years that you would see that I'm giving them positive growth, you would see the reinvestment being positive, and this is the reinvestment rate, which is how much of the operating income is being reinvested into the business. So with that said, you sum this column up, the value of operating assets come to be on 1.6 billion. You add cash, then the firm value comes to at 1.8 billion. You subtract that, you are left with what's left for equity for the owner of the business. That would be about 1.4 billion dollar. The current market cap is at 1.1 billion. So I would think the stock is about 30% undervalued. Similar to every other evaluation that I've done in the past, I am dealing with the uncertainty around all of my estimates with a Monte Carlo valuation. This is not rocket science. And what it is, I am going to randomly draw a number within the range that I'm comfortable. For instance, for the operating margin, I would think their terminal operating margin would be between 6% to 11%, and I'm centering it at 7.5%. And this is a trinomial distribution, which is there's more weight to 7.5, less weight to 6, and then less weight to 11. You could look it up and see how the probability is distributed around these numbers. But essentially, I select different distribution with different standard deviation and ranges around these parameters that goes to the model. And I also build some correlation between these variables. A good Monte Carlo simulation is not only the ranges that you have in the parameters in your model, but also the interaction between the parameters. So for instance, if I give them high growth rate for the terminal revenue, that's indicative of high growth rate risk-free rate, which indicates of economic growth rate plus inflation, that reflective of monetary policy. So you have to tie them together. Same with the additional return on cost of capital in perpetuity. If I give them additional return, if I give them credit for producing additional return in cost of equity, it really comes in in a couple of ways. They have high sales to capital ratio, which means they reinvest efficiently, and they also have high operating margin. Again, so they're running the business efficiently. So you have to bring those correlation into account. And that's what makes a good Monte Carlo simulation, a good Monte Carlo simulation, if you would say, when you take the interaction between the parameters into account. So doing that, I perform a 12,500 DCFs, and I calculate the equity stake in the business, and I come up with this distribution. This is my low estimate, which is 1.2 billion. My mid estimate is at 1.4, which is very similar to my point estimate that we did above. And my high would be 1.7 billion. And I'm seeing the current market cap is about 1.1 billion. And looking at cumulative distribution of my valuation, I find the current market cap to be around my fourth percentile of my valuation distribution. With that, I do believe that this business is well underpriced. It seemed to have a good history in terms of it has been run, generating consistent good return on invested capital. And at this valuation, it's really attractive. I will be taking some position in this business. The link to this Colab file and the valuation model that I have developed with Python are going to be in the description of this video. Please feel free to go and download the files and value this company or any company on your own. If you would disagree with the parameters or even the distribution that I have in my model, for instance, if you would think the margin expansion will continue to go higher and it will perhaps get to maybe you would get to even 12%, you can change these numbers, run the valuation, and see what it would be worth for. But if you, for instance, if you would believe it would be at 12%, it would go to all the way to 2 billion. If it goes to, again, 8%, what I had would be about 1.4 billion. So with that said, I hope you find this session useful. Thank you very much for listening and learning about Lazy Boy with me. And I see you in the next video.